Greetings, this is Dr. Jeffrey Scott, and this is my weekend market update for May 29th, 2022. I titled it, Have We Found the Bottom, or Is Another 2008-like Sell-Off Coming? My email address is hgsidoc@gmail.com, and if you're watching this on YouTube, make sure you hit the subscribe button, hit the alarm so you get notified when I post these, and I'll also mention my site where I post short videos on a daily basis. I think this could be an interesting week, although, cut to the chase, I think we're going higher. Now let me tell you why. Also, for those of you that served, those whose family members of those who served or serve currently, those who gave the ultimate sacrifice, we thank you for your service on this Memorial Day, which I didn't realize was not a holiday officially until 1971. As always, it's for educational purposes only. Any recommendation should be considered just education and not investment advice. I'm a doctor, not a broker. I use the tools that I've paid for, and trading involves risk. You are solely responsible for any investment decisions you make. If I talk about example trades that I might be looking at, they are just examples that fit my trading plan, my economics. Since I'm not aware of your trading plan nor your financial scenario, they may not apply. An important point is this first line here that we've seen is that high growth stocks fall like rocks. They may go up like rockets, but they fall like rocks. And it's important for you to know where you are in the stage as you decide what you're going to do in the market. These are Stan Weinstein stages. And we have been in stage 4 fear. That's pretty, I think, obvious to most of us. And the question is, are we just doing a little pull, retracement, and then we're going back further down, which I think has got to be the most likely scenario, or have we trickled around into stage 2 and the market's only going up from here? Less likely, not impossible. I mentioned that I have a site, stocksanddocs.com. This is a site that we're creating for busy traders who have full-time jobs where they're supposed to be 5 minutes, they're usually 7 to 9 minutes, I'll get them shorter. Pre-market updates where I talk about what I think is going on in the market and mention a couple of the charts that are interesting to me. Also, and there's no slide for this, so I'm going to talk to it, I am participating in a live trading event in Orange County in June 17, 18, and 19. People are flying in on the 16th and going home on Sunday the 19th. If you are interested, we have a few spots left, both live and online. It's a rather modest budget meeting, and just email me at hgsidoc@gmail.com and I'll give you the information. There'll be probably 4 or 5 speakers, and we'll be packed with trading ideas and different approaches that we take in the market. Now, as I start every one of these videos with, I want to know what happened last week. And so this is an important sheet for me. And what it has here is the major indexes. I take this out of HGSI and the sectors. And I've got a warehouse view that basically is sort of my what's the market doing sheet. And if I look here in the current interval from 52-week high, I could see that the NASDAQ's down 25, Russell's down 23, S&P's down 13, and Dow is down 10. So we're in a bear market in the small caps and the NASDAQ technology communication, and we're just in a pretty good correction in the others. Now, there are places where this market has crashed, whether it's the ARK, Innovation, Bitcoin, IBD 50 type stocks, the FANG stocks, although this is leveraged, and then biotech are really more in a market crash. Now, the other thing I wanted to point out here is that we have moved up off the lows. And not only have we moved off the lows in the last 7 trading days, 7 to 15 trading days, we are between 8.4% and 11.1% off the lows. That in itself is a pretty significant bear market rally. The other thing, over 5 days, the only thing that was down was the dollar. And you could see we had some big moves in some of those beaten down. ARK Innovation was up 7, IBD 50 ETF was up 9, The FANG was up 7.4, and you could see the major indexes were all up 6%. A very strong week. On the sector front, communications, technology, discretionary are the big losers. And you could see, look at consumer discretionary, 13% off their low in 3 days. I like to look at these from the Q series of tools by Sager. Just in case you're wondering, can we get Sager's tools into wealth charts? We've had that discussion. I've had the discussion with Rob Hoffman and team, and that's something that we might try and do later this year or next year. But this is a glimpse of the market breadth, and I point to these top three up here on the right. 100% of the sectors were up Friday, 99% of industry groups, and 94% of stocks. In fact, we had 3 days in a row of 80 or 90% positives on the major indexes. That does not happen often. And what's interesting is when it does occur, the markets usually do well thereafter. That's not a surprise, except for 2008, which I mentioned in my title. If we look at 1 day, Friday, 2 day, Thursday and Friday combined, the week, you can see this market has turned around, and what was very red just a week or two ago is now very green. So we are clearly in the setting of, at the minimum, a pretty significant bear market rally. If we look here in the buckets, you could see a week or two ago we had many stocks below the Bollinger Band. Now we have more above the Bollinger Band. All the sectors were up on Friday. And you could see, and we'll come back to this in a minute, 85% of the stocks in the S&P 1500 are above the midline of their Bollinger Band. The warehouse report, imagine if you could take the fundamentals in the market on Friday last week, not the Friday 2 days ago, and then look going forward, how do those fundamentals impact on the market? And specifically looking at EPS rank, relative strength rank, and group rank. And you could see when you add the three together, the most you'll have is 299, 0 to 99 for each one. And notice, I guess 297, that lower left to upper right, we throw out the head and the tail because just the numbers are too small. But clearly, higher growth did better this week. The other thing is all the groups were above zero. So it was a very powerful week in the market. This is percent return on the week. High EPS rank, check. That was good. High relative strength rank, check. The good strong groups last week, check. Worked again this week. And turnarounds, which would be stocks whose growth rates had stubbed their toes and are projected to start growing again, group 7 on the boxes. And if I don't forget, I'm going to close with Ian's boxes today because they're kind of really cool and apropos right now. NASDAQ, if we look for where are we at from the big picture, there is no evidence of a Hindenburg omen. If you do not believe that the Hindenburg omen is meaningful and think it's old wives' tale, it ain't perfect, nothing is. Go back, look at my videos in end of December and early January and how many times on the NASDAQ we saw the Hindenburg fire and what happened in the NASDAQ, 30% down. The weekly bongo is still red. I'd look for that to change this week if the market keeps going higher. We did get what it's called a Eureka, which is Ian's follow-through day on Thursday on the NASDAQ. If you follow William O'Neill, we did get a confirmed follow-through on the NASDAQ on Thursday as well. So investors.com is calling this rally market and confirmed uptrend. If we look down here, we could see the first week in 8 that we were actually up, and we were up 6.8%, up 3.3 on Friday alone. Now we're down only 25%. And again, we are 7 days off the bottom, nearly 10%. If you look at the NYSE, it looks very similar. Weekly bongo is red. We had a Eureka on Thursday to the upside and strong weeks as well. I showed you this earlier on the Q Edge tool. This is using Edge Rater. No pun intended, I think, of the two names. 84% of the stocks in the S&P 1500 are above the midline of the Bollinger Band. We're at 18% of stocks above the Bollinger Bands, but I've seen it get to the 30s and 40s before the market reversed. So this is a strong, bullish look to the market. Compare that to a week ago and 2 weeks ago. What a change. What a change. Hopefully when you see something this strong, it's not a one and done and it continues to give us several more weeks. And I think this is a very, very bullish picture. Chris is a good friend of mine. He lives in England and he'll be participating in that educational event. I think he'll be zooming in from England, however. Energy, I've been talking about natural gas. Rob Hoffman talked about um, energy on his weekend video, which I got the chance to watch earlier. And you could see on the weekly column here, there's a lot of green. Coal gave back a little bit, but look at coal, up 285% for the year. So you'll get ebbs and flows daily in energy. Natural gas is one that is quite volatile. But when you look at year-over-year returns on energy, 192% on natural gas, 285% on coal. Clearly, there's an impact of what's going on in Europe with Russia and Ukraine, and even crude oil is up 74%. Major year for energy. Maybe it's not stopping anytime soon as well. If we look at some of the metals, you could see over here on the year-over-year, not a major year. Lithium is on fire, and the lithium stocks took off again this week. ALB, SQM, I believe, are the two that I own. And then there are LAC and I think LIT and a number of others, driven clearly by batteries for electric cars. But notice silver's down 20%, gold's flattish, down a little bit, iron ore's down 31%. I've been a big fan of marine shipping and things like Zim, Star Bulk carriers. There's so many of them. And they're driven by the Baltic Dry Index, which, if I remember correctly, are the rates paid for spot shipping. And you can see they're pulling back to trendline support. And look at how much this trend line has gone in the last 5 months. There's no question, even though this is a big pullback from 3,400 to 2,700, we started at 12 and we're at 2,700. That's a crazy move since February. Interest rates, if they go down, that might support the continuing rally. We've been talking about looking for the 10-year to pull back. And you can see both the 10-year and the 30-year pulled back, and the S&P moved up. Credit risk, I mean, how tight is the money supply? Actually turned down some this week. That's important to watch. This was going up in 2020 before the market rolled over. And then this is the spread of the 210s, which we know already went negative this year, which triggered a lot of concerns about a potential recession. Then how about stocks above the 200 and above the 40? And you can see in white that the percentages increased in both, pretty significant in stocks above the 40. And if we look at my very short-term 13-week new high, new low, the T2121 in Warden rebounded nicely from oversold to approaching overbought. That breadth thrust is a bullish sign. Economic news this week will be busy after the Monday holiday. You got some homes and PMI, consumer confidence on Tuesday. On Wednesday, you got some PMI and manufacturing, beige book from the Fed. Thursday, employment reports, capital goods and factory orders. And then on Friday, the monthly unemployment report. Not to forget, we also have a lot of earnings results this week. And as I've said in prior presentations, it's a judgment call to hold stocks over earnings. It's bad judgment to not know when the earnings date is. So I'm going to be watching because you got stocks like Salesforce, Ambarella that are starting to show some life that have really been beat up. And will they trade up on earnings, whether they're good or bad, like we saw last week in some of the beat up retailers? Capri is, I think, got a multiple in the single digits right now. Will that respond like some of them did to the upside? Or will it look like Gap and trade down further low? So there's some interesting stories this week on the earnings front. Expected moves tell an interesting story. Now remember, this is you going in and saying, I'm going to buy a call and I'm going to buy a put at the money. And I'm going to only make money if the move is beyond the price of two premiums, the call and the put premium. Doesn't matter which way it goes, but if it moves more than 2 times the premium. Now, the person selling you money is the option market makers. They are the smartest money in the game, so the game's going to be rigged against you, where we know that over 80% of the time, you're going to lose, meaning the price is going to finish in between the green and the red, which are the 2 times premium that you will be paying. Now, the gray bar represents where it closed the prior week. Now look what happened in the S&P. 1, 2, 3, 4, 5, 6, 7. Pretty much 7 weeks in a row to the downside. Could have been 8. I didn't look close enough here. All right. And what happened this week? We closed not just above the expected move, but way above the expected move. The NASDAQ, way above the expected move. The Dow, whoa, way above the expected move. And the IWM, the only thing below the expected move, how about the VIX and the dollar at the bottom of the expected move? So the market makers got, I won't use that word, they got killed this week. Now, is this a one and done? I don't think so. I think we'll probably get a couple weeks to the upside after this ferocious of a move. We'll see. So my thoughts, follow 7 8 weekly closes, the market's rallied. We had an IBD follow-through day, confirmed rally call. Could be the beginning of the end of the correction or just the beginning phases, the end of the beginning phases. We don't know that. Fed minutes viewed with little surprises. 2 more 50 basis points raises baked in at least. And then we had the Atlanta Fed head say maybe they'd pause. Not confirmed by Powell. You had some data at the end of the week suggesting that perhaps inflation is starting to moderate. We still got earnings and news. There's still a war going on. I've looked at over 1,500 charts this weekend, and they look better than last week, but you still have a lot of stocks that are making bottoming-like patterns and starting to move. And whether or not these are going to be traps or a beginning of new root moves really depends on what the major indexes do. And these are what's going to be required for me to believe the market's going to new highs. You can check off the follow-through day. We're working at higher highs. Probably haven't had much time to really create the higher highs and higher lows. And then we want to see breakouts. We'll tie that into the box discussion at the end. So put in the back of your mind, though, that markets will bottom typically before the Fed and the economy have signaled all clear. And no one knows for sure, especially me, how far this current rally will go before pulling back. I have increased my exposure on the long side. Now, just to tickle your fancy. This is a TradeStation chart that incorporates the Q tools that I mentioned that I am talking with Rob about, and I've talked to Sager about getting them incorporated into wealth charts, which I think would be awesome. And then also something from Roy Kelly, which is my cycle finder. The cycle finder is down here, and when I get the red line on a V, that typically tells me that we've got a meaningful bottom in play. When I get that going up with the red line, it's typically a top. This is the March top. There's a higher top back in beginning of January that has the red line in it. But if you look at what happened at this intermediate top, you got circles and pluses, which represent headwind and stretching, which are signs of exhaustion of the trend. Okay, you have an arrow there, which is a John Person sell signal occurring at prior resistance. Big sell-off, and at the reversal, not only do we get the inverted V here, the cycle bottom with the red line, we had some pluses come in, the arrow, circles, arrow, circles, arrow, plus arrow. So this is what a pattern that is very suggestive of at least a short-term, if not longer, bottom. Now, interestingly, everybody, including Jeffrey here, me, don't think this is just like 2020 and we're going to rocket out of this. But let's look at that 2020 bottom. Got the same V with the red line. You got the circles and the pluses and the arrow. You got a very similar pattern of the March 2020 bottom. Now, in this case, you can also see at the top, you had the pluses and the circles, the headwinds and the stretches, as well as the person's sell signals. So we shall see if we have a meaningful bottom here. I just thought it was interesting how it looked kind of similar to 2020. And then to remind you, https://stocksanddocs.com for a free short video every day around the time the market opens, giving you what I think is going on and what I'll be watching. All right. So let's jump into wealth charts. And then as long as I go through this quick enough, we'll jump into HTSI and I'm going to talk about the boxes. So look at the spider, and I think it tells the story. We have pulled back hard, and we've bounced. We've had 3 very strong days. If you look at it, we tagged this line here, which would have been the 24th, and then the 25th, the 26th, and the 27th. And the 23rd, excuse me, the 23rd was also a strong day, but we opened down, closed down, but came back off the bottom. This line here you've not seen before, and I saw this in an email, and I said, I'm going to see what it looks like. This is the anchored VWAP from Brian Shannon, and when you apply it to the bar of the low on the March 20th, 2020 bottom, and then you go and look at current dates, how bizarre is it that it actually is where the market reversed? Now, one of the things I like about wealth charts is they've got some really cool indicators in it. If you add an indicator, they've got 3 types. They got standards. These will be things like your MACDs, your Bollinger Bands, your moving averages, and some other things that you may not have heard of. And what I've been told is that if you are an annual member and you have something you're interested in, that they will actually program it in with the idea that if it comes from a member, it's free to everybody else to use. How cool is that? The premium indicators are from folks like me and others that have created some packages. They're also free, so my Bongo and my Impulses are free. But if you look here at Brian Shannon, the anchored VWAP, so that's what I used here as support. And then the marketplace are a series of indicators from similar people, the same people that are fee-based. So pull back to the anchored VWAP and bounce. Wow, isn't that cool? Anything else I want to show you on this? Let me see. I don't think so. The weekly, you can see a reversal here, but it's a 1-day or 1-week reversal. Notice that the daily Bongo has turned green, and on the monthly, you could see, imagine that, pulling back exactly to the predicted $380 range and the 23.5% Fibonacci retracement. How did that happen? How cool is that? The markets are smart. No, people have buy sells and the algos kick in when they get to those levels. The markets don't know one level from another. They're numbers. The Qs, similar pattern, moving up off of its lows, as is the diamonds and the Russell. And notice you have EMS signals on all 4. The VIX broke down below the 200, and what I'm happy to see is the dollar's come off its highs. It's now bouncing around the 50, and you can see here on the weekly, we've had 2 very strong reversal bars. If I go into commodities, we'll start with the 10-year, just like the dollar. It's pulled back to the 50. Here's the weekly. Nope, the weekly are the wrong thing. Touch this. Now I'll go to a weekly. And you could see, again, it's early in the pullback, but you've had a reversal candle and 2 others, so 3 red candles in a row. That would be extremely supportive of the market and might be telling of a prediction of the slowing down of the Fed if this breaks down and continues to fall. Oil almost back to their March 8 highs. We'll see how much further oil can go. My bet is it goes a lot further. And then down here you have natural gas, which is just out of control. This is one of the most volatile markets I've ever traded. I'm in Boyle, which is a 3 times natural gas ETF, and I have options on it. And I take profits along the way, so bad days are bad days, but they don't ruin me. And this example on Friday, futures were, UNG was down about 3%, 4%. And if you've got a leveraged instrument that's 3 times that, it would have been 12% down. And then you have options on it, Widowmaker. And before the day was done, it closed down less than 0.5%. It's just how volatile natural gas is. What a powerful uptrend. Gold struggling at the 200, and silver is just dead for right now. Market theme, if I look at the short term, you've got perhaps some interest in small caps. Remember, if you point to the upper right, it's large caps. The bottom right, it's small caps. And momentum showing a little bit, growth showing a little bit of interest. But if you look at out over the daily charts going back a longer period of time, it's pretty clear that this has been large cap and value driven. S&P 500 sectors, what I like to do here is I like to use ratio charts versus the spider. And then I could see relative to the spider, how does each one compare? Easy to take a quick glance. The strength is materials, energy, and I guess kind of maybe utilities. Discretionary has been awful, but it's turned around. Healthcare came back a bit this week. So materials, energy, utilities. Now, if I look at seasonality for this week, and I just put up the S&P sectors, only 3 of them made the count for bullish. So this is a much less bullish period we're going into. In fact, if you look at XOK technology, you could see here 5 up, 5 down, return 1.2% average. Not horrible, but not great. And if I just put the spiders in here, 5 and 5, 1% return. So at best, this is a flat month coming up. But, you know, whatever that means. Sometimes sell in May, go away works, and this is probably why. But, you know, the way the market's been, I think we're going higher here, at least for the very short term. Now, let's go into my bullish dashboard, and let's start by looking at the heat map of the S&P 500, and one could see how bullish the S&P 500 was. Green wherever you look. If one goes into the sector scanner, you can start to see first that every sector was positive on the weekly and the daily. Now, keep in mind, Sager's work is on the S&P 1500. The S&P sectors are on the S&P 500, and these numbers are based upon a much broader set of stocks, but broad-based strength. So we already said that materials, energy, and utilities were the leaders, at least on the ratio charts. If I set by daily algo score, I'm not really interested in communication services right now, but they are moving off the bottom. You could see that the algo has these as 3 of the top 4. If I look at what really moved this week, let's just add for the sake of building technology and healthcare. If we look at the weekly algo, just to make sure I'm capturing what's moving, I've got the energy, utilities, and materials, the top 3. Now, if I was doing top-down investing, which I do, I might say, all right, these are the industry groups in the top of sectors, and then I'm going to rank them, say, by daily algo. Why not? And I'm going to capture, say, let's capture all the way down here. Hold the shift key in, left click. And then I want to look at weekly algo. And there's no rhyme or reason or magic. I like doing it this way. You may have other ways of building your watch list. Make sure we're ranked by weekly, and let's make sure that I haven't missed anything. Fill those in here. All right, so these will be the top industry groups and the top sectors. And I'm going to hit compare. And now I get the top stocks. And let's just rank them by algo. Gilead up at top, look at that. And then let's take it down to 650. And here we went, top-down investing, the top stocks in the top industry groups in the top sectors. Let's look at my watch list, make sure I change it to weekend review. That's there. And let's add these to that watch list. Now, I combine that with some other lists that I've put together over the weekend, and that's where my bullish list is, looking at it over the weekend. Now, if I go to Wealth Scanner, I have a couple things I like to do. And this is ranking by a algorithmic scorer. I've set the settings to be a swing trader. It's quicker if you're a day trader, but to set it as a day trader, but swing is what I do. And I've took out weekly and monthly time frames, so it's a little shorter time frames there. Natural gas has been the big winner for so long, and again, you could see just the crazy move it's had from 16 to 32, doubling since the beginning of March. Natural gas, oil services, oil production, energy, oil, then commodities, utilities, short the bonds, dividend players, XME, pharma, and agribusiness. Now, this is not saying that these have the best pattern today. They're not saying they're breaking out and at buy points today. That's telling me that these are the leaders. Now, sometimes the leaders aren't good buy points. I use them to tell me where to look. And let's look at energy to start with. So CAT Scanner allows me to search the markets, and I have 4 clues I'm looking for. I'm looking for momentum. I'm looking for a breakout, big volume, or a big gap. And I could filter whether there's a squeeze or not and a number of other features. So interested in energy, my concern is energy's probably moved too long, but let's find oil and gas. Here it is, oil, gas, and coal. And let's rank by dots. And typically, and it's real strong, I'll see 3s and 4. Let's just look at the first couple. DKA, Delek US Holdings. This is a refiner stock. Now, it's already had a big run, and you could see the big breakout here. So you're coming in a little late to the game. You could see the relative strength and unbalanced volume is pulled back with price, so that might be setting up a new buy. The high jump at 77 is not too far gone. All the bongos are green, and you did have a volume and breakout signal on Friday. So this is one that I might put in a watch list. It's had a big run, but it's pulled back and looks ready to go. PBF, similar story. So I've not just found stocks that have broken out. This one's actually squeezing with momentum and a breakout. I can go down the list, and I believe, ESTE, I'm actually in this stock. And if I go back and look, I got into it back here. And why did I get back in? Because it was in a squeeze. It broke above the 17 with a breakout and momentum, and it's still running on high volume here. But I use this to find. I don't have to look at thousands of stocks. So that would be energy. Well, what if I don't want energy? Well, let's go to our weekend review and see if anything pops up. Again, let's do it by bullet. So IMAX. And this is what you're going to see if you look at a lot of stocks this week. You're going to see stocks that have had up and downs. Here's one that ran up and then, like the market, started selling off. And is it getting ready to run again? I think it might. Now, I'd rather not buy right below the 200. This has a tendency to be resistance. But I had a big gap up on Friday on volume, a breakout in momentum. I cleared the 50. I'm definitely not extended. Above 95 and below minus 95 are extended. We're nowhere close. Relative strength and volume look good. Look at the absolute volume here. Not usually a stock I'm buying, but I'm going to put that on a watch list and see. SIGA, I don't know what to say about SIGA. I know my buddy Kathy has this. Look, these are great if you get out at the right time, and that's the key. You look at Plug, you look at Lakeland Industries with Ebola. Um, these stocks run up on news and they come down when the news goes away. Right now, the country seems to be nervous about monkeypox. If monkeypox turns out to be as insidious and everywhere as COVID, then you're going to have the stock be 1,000. And if monkeypox turns out to be limited, this will go back down to 7, where it had been for years. Ulta, great earnings this week, and looks what happens. Stock been a huge uptrend, sold off with the rest of retail and discretionary, and then they had good earnings. So here's your 4-dot move, closing at the high. Now, 86%, you're still not extended, but my goodness, I have a hard time buying a stock that's had such a big run. And, I guess as long as it stays above 410, you can be in this stock, 410-ish, 48. But boy, what the market's rewarding stocks with good earnings. That's all I'm going to say. Adobe is another of the pattern that I saw a lot of this weekend, and you could see the stock has come off a mile. I guess it's a stay-at-home play as we spend more time online, but it's been around a long time. The Creative Suite, Photoshop, Adobe, the PDF Creator and Reader. Love the pattern. Pull back, sideways, in a squeeze, and a breakout here with volume and momentum. And you can see relative strength and OBV are turning up versus their moving averages as well. I could go through this list and show you lots of stocks like that. Here is Horizon Pharmaceuticals, same pattern, but it's got to get above the 50 as well. This is one that was just a great mover. In fact, I've been talking about this stock for years. It was a $20 stock not that long ago. You can go back here into 2018. This has been one of the big movers of this the last 5 years. Is it ready to run again? You got a breakout with volume and momentum. These are all stocks that have overhead supply. All these people might be looking to get out and resistance to get through. If you like this pattern, there's thousands of them this week. We already looked at Adobe. I want to look at Autodesk, which will be the same pattern as it's gapped up and gotten beyond. Gap up with good volume, not enough to trigger the volume side, and also a breakout and momentum from a squeeze. And this is Autodesk. Did not find a lot of bearish candidates this week. That could change quickly if the market decides it's done going up. And then another way to play these markets might be the contra ETFs. Let's go into the watch list of the ledger. These are the positive ETFs. These go up with the market. These have been beat up big time. Triple Qs, TQQQ, 3x the Qs. All right, this thing was as low as, it's not going to tell me, say $25 on the 20th, and it went out at $33 on the 27th. So 25 to 33, that's over a 30% move in a week and a half. So these things can move. They constantly look like this on long-term charts. These look good on long-term charts. They've been selling off with this market sell-off extremely hard. It's the contra ETFs that look like this on long-term charts. You get in when these are low and you ride them high. There's some people that all they do is trade these. They are supercharged, high-octane trading. But when the markets are at turning points, if you're in the right direction, they can do very well. You can look at TNA, which is leveraged on the small caps as well. Similar big move. You could look at things like the IBD 50, FFTY, if you believe small cap growth is coming back. If you think the FANGs are coming back, FNGU, and there are other ETFs that will trade this. This is actually a 3x the FANG. So I'm just going to summarize by saying it was a great turnaround in the market. No one knows how far it's going to go. I am not, let me emphasize, I am not saying all in. I am not saying load up the truck and go into margin. Maybe I should be saying it, but I'd rather protect my granddaughter's money. I already bypassed my kids. Nothing's better than a baby granddaughter. Um, and I'm going to be a little more careful, but I do think it's a time to take some more positions in this market. Now, I'm going to pause this and give a quick show about the buckets.